Hi everyone, welcome the early birds. Thank you for being on time. We'll give some of the latecomers a little bit of an extra buffer before we properly get into it. But for those of you who've been on this market update before, I'm joined by all of the big names, or some of the big names of Swoop. So we are very privileged to have three heads of department today joining me for this market update. People don't all need to see the introduction. So the early birds can see the introduction. So we will start with Kerry. If you could just do a quick introduction to who you are, what you do at Swoop, and yeah, that would do.
Yeah, thanks, Sam. So I'm Kerry, and I look after the equity and grant side of things at Swoop. So been at Swoop for 2 years now, which is a bit crazy. Actually, more than 2 years, I think. And yeah, day-to-day job involves speaking to a lot of advisors. So I've probably spoken to a lot of you guys, and a lot of businesses and a lot of investors. So helping businesses to get access to investment and also to find the right grants. But yeah, we'll go into more detail around each of those.
Perfect. I know advisors get particularly excited about grants, so we'll have a bit of a focus on that later on. Thanks, Kerry. Rhys, welcome back from Australia.
Cheers, Sam.
How was it down under?
It was good. Yeah, I think I've come back. I brought the weather with me, so no problem for that. I can see that there's a few attendees on, which I've spoken to quite often. So for those that don't know me, my name is Rhys. I head up the Unsecured Asset Finance team. My background prior to joining Swoop was working for RBS across two of their separate banks. One was NatWest and one was Coutts as well. So looking forward to today's webinar. And if there's any follow-up questions, please feel free to connect on LinkedIn, email me, ring me. Always up for a chat.
Cool. Thank you, Rhys. And Stu, we'll be a bit gentle on Stu because he's a bit drugged up today. So please be nice in the chat if you've got any questions. But Stu, do you want to do a quick intro?
Cheers, Sam. Afternoon, everyone. I'm Stuart. I look after our commercial mortgage and property finance proposition here at Swoop. Similar to the other guys, head of the department, look after the team, work with customers, work with lenders, and again, I can see a number of advisors on the call that I've spoken to individually as well. So nice to see you all joining us. And yeah, looking forward to getting stuck in and giving you an update as to what's happening in our world.
Perfect. Thank you, guys. And just quick intro for me, if no one knows who I am. I'm Sam, head of Swoop for Advisors. I'm a chartered accountant by background, so don't hold that against me. So today I'm basically going to try and get as much expertise and knowledge out of these guys. And I will always then try and focus it back into an advisor lens and how you can share some of these things with your clients, but also help to spot opportunities within your client base. Because as we all know, in the current environment, businesses are crying out for this sort of support and knowledge. So we just want to give you all the tools to be able to do that in a nice, succinct way. So I'm going to do something a bit strange today, and I don't know what the weather's like where you guys are, but in Yorkshire, it's pissing it down with rain. So feeling a bit glum this morning, rather than yesterday was feeling very, very bright and sunny. But so we're going to start with some doom and gloom. And last week we had another base rate increase, as I'm sure you guys are all aware. So just keen to hear from the three of you what sort of effect that might be having already, where you think, if you were to be Mystic Meg, we might end up in the next few months as well. And then later on down the line today, we'll talk about looking on the bright side. But where are we, guys? What's going on? What are the biggest challenges in your sectors? Let's start with you, Rhys, first, given the base rate is probably having quite a big an effect.
Yeah, I mean, where are we at? Inflation, base rate, no one really knows how they're working together and how it's decided. But I mean, from a lending point of view, there's two sides of it. One, the cost of funds is, it's common sense really that if base rate increases, the cost of funds also increase. But on the flip side is, if you have clients or yourself personally and you've got money in the bank, it's also a positive. So there is the doom and the gloom of the lending side, but also there is the positive if you have unutilized cash within the bank to kind of make that work for yourselves or partners, businesses, etc. that you work with. In terms of from a lending side and where we've seen it, since November 2021, there's been a dramatic increase. Where we're at now, I don't know if we can go much further, maybe 50 bits, so 0.5%, 1% more. who really knows? It's going to kind of look at the inflation that is happening and how that is then perceived to stabilise it, to reduce it. So, I mean, from a lending point of view, it's the cost of funds has increased, but within the unsecured and asset finance world, it only increases with base rate. So they're not adding any more percentage other than the base rate on. So it's gradually increasing from where we were, let's say, during the pandemic, when there was a lot of government funding knocking about with bounce back loans, C-bills. There's still RLS loans out there, which, you know, there's more lenders now stepping into. We're seeing more lenders actually take up on to the new RLS, and there'll be more kind of lenders taking this up, I would say, over the next quarter or two as they kind of get more familiar. There is the word within the industry that the minimum percent, which was capped at 14.99, is actually going to increase to 19.9. So that may seem absolutely ludicrous to some people on this call, but that is for unsecured funding where there is no property backed, but they will require some sort of PG. So again, you know, base rate is increasing, but there's still a lot of liquidity in the market and a lot of lenders, high street, second tier, and kind of alternative funders out there, which are doing record months of lending still. And that's because business need funding. They need to grow, and they're willing to swallow the cost of it to kind of navigate a way for growth. And if they don't take it, then they can't grow their business. So to answer your question, Sam, who knows? I can pass that on to Stu, who might be able to shed more light on it. But my view is potentially slightly more of the next couple of quarters at least that we may see an increase.
Is that the hot potato well and truly passed over? Lovely. Yeah, I think the more sophisticated entrepreneur SME in the space really grasps it and probably understands that base rate has been artificially low for a prolonged period of time. It has been far too low for too long, which is why we're probably seeing the inflation pressures that we are seeing now. So there's a segment of customers that know and understand and appreciate that, you know, we've had it good for far too long, and you know, this is just the market normalising. There's a much broader market where customers are really struggling to be re-educated around pricing and what it means. The challenge with that is that, you know, in their mind, they still think they should be a pay rate should be 3-4% on borrowing, where even the best businesses now, you're probably looking double that. So that is a bitter pill to swallow, and it's another cost for a business to absorb. But it's not just that in isolation that's causing an issue, it's the knock-on impact that it causes. So if I look at primarily the property space, which is the area that we work in, the impact that this is having is that we're actually now seeing commercial valuations come in lower, significantly lower than they were previously. We're also seeing valuers that will change their approach depending on who they're valuing for. So if they're valuing for a tier 1 high street bank, they'll be a little bit more bullish because they know the bank has a bigger balance sheet to support them, and they know their risk appetite has been relatively sedate over a prolonged period of time. So they're quite comfortable at knowing that their PI cover won't be called on. Whereas if we look at some of the tier 3 lenders, some of the more aggressive lenders in the property space, whilst the open market value will remain as it is, these lenders tend to work off a 90-day or 180-day value. Now, valuers are actually hitting those values really, really hard at the moment because they're looking at it and going, actually, with these sort of tier 2, tier 3 lenders, that they are a bit more aggressive in terms of their risk profile. But they don't have the same size balance sheet to stand behind this customer than a high street bank would do. Therefore, they're hitting those numbers really hard, and that is having a big impact on some transactions. So it's not just the interest rate environment itself, it's the knock-on impact that is now causing, certainly in our world when it comes to valuations on properties.
Just on that, Stu, I think, you know, from what we're seeing in the unsecured and asset side is, yes, the cost of funds are increasing. Everything, inflation is increasing, but what we're trying to help businesses do is reduce other costs that potentially maybe 4 or 5 years ago weren't looked at. So whether that is insurance, whether that is energy, and other business contribution factors such as bank accounts, the charges, FX, etc., where I think that we're helping a lot of the clients mitigate the cost is actually taking the overall view of the client and looking at areas where, okay, you may be paying more than you were 18 months ago, 24 months ago on your interest, but you can save X, Y, and Z through these products by moving to a different provider, shifting banks, and taking the offers that many high street banks or kind of alternative banks are actually moving forwards with in regards to charges. And particularly depending on the sector, whether it is FX or you've got high utilization of energy, it's effectively looking at everything that a business pays for. And it's then looking at how we can mitigate that to offset the interest as well.
Yeah, absolutely. Well, I mean, what we're trying to achieve here is looking at a business completely holistically, and Kerry, grants is a huge part of that, and we'll come into that in a second. But what some people won't realise is the effect that this interest rate increase has on equity investment and the potential and the appetite for investors. Do you want to tell us a little bit about that?
Yeah, I was kind of thinking about this in good detail before the webinar, trying to think, how do we actually look at the equity market at the moment? Because similar, I suppose, to what Stu was saying, a lot of the area of equity that Swoop works in is quite a private market. So it's quite hard to actually analyse market trends unless it's retrospectively. So I suppose it would probably be good just to take a step back for a second. So for the advisors on this call who maybe haven't worked with us on the equity side of things in particular, firstly, apologies if I'm teaching how to suck eggs, but equity is essentially the most basic form of investment in the sense that you're just purchasing shares in the business and you therefore own a part of the business. But there's a huge landscape to that. So the public market's probably something that a lot of people on this call are aware of. You see the likes of Facebook and Google and their stock price going up and down every day. But where Swoop comes in and kind of acts as a guide is more in the private market side of things. So particularly around the venture space, and venture capital is where very early stage businesses are looking for investment. So analysing that market, a lot of that information isn't made public until after each quarter. So it's quite hard to kind of say exactly, keep your finger on the pulse on the live data. But yeah, I think it's similar to Stu in the sense that, when we talk about the interest rates having an effect on commercial mortgages and valuation down the line, for equity, it's really a case of you'll see changes in the public market and then that it has a little bit of a lag into the private market, or a lot of investors, kind of panic and we see the impact there, which is like a halt for a while. But yeah, it's pretty doom and gloom in the equity market at the moment, unfortunately. I think the grant side of things is a bit more positive. But yeah, I can go into a bit more detail in terms of kind of the trends we're seeing in terms of sectors and everything in the equity side of things. But I would echo what the guys were saying in terms of how everything is interlinked. So if those base rates go up and then, investors kind of go, okay, the cost of debt is much higher now. Maybe we need to focus on investing in the companies we're already invested in and really deploying capital there. So maybe there's a slowdown as a result, or potentially they're kind of, taking a bit more the numbers into account a bit more than usual, whereas previously they might have been going, okay, this is a huge opportunity. Now we see like due diligence is kind of dragging a lot. And then I think also, like, Sam, you mentioned we've got the experts here in each area to chat through. I think equity is just such a black hole, and like where Swoop is kind of trying to help there is that we're just a guide and really trying to like simplify everything in the equity landscape. So trying to look at those trends and trying to break them down a little bit where we can, and maybe try and be a bit more positive about it as well, through other areas of funding. But yeah, overall, pretty negative view. I did a webinar recently with NatWest, and I was looking at my slides from that a few minutes ago, and they were so much more positive compared to the turn that's happened in the last 6 weeks. So, yeah, it's just very up and down, but still lots of positive stuff on the seed stage side of things, which I can go into more detail on. Or
yeah,
can I just pick up on something that Kerry's picked up on there as well, because it's something that's relevant to our market as well at the same time. And I think there's a lot of crossover between the equity and the sort of the senior debt, secured debt piece. And I think your point around timescales and there being a lot more due diligence, and I don't think that's necessarily a bad thing, but I think what is driving that behaviour essentially is a lack of confidence. A lack of confidence knowing exactly where the market will be in a week's time. And you look at some of the larger lenders that play in our space, they're also lacking confidence. In the last week, we saw one lender swap rates, and I encourage you all to look them up. Swap rates have been going mental over the last couple of weeks, rising to levels that were actually higher than post the mini budget from Kwasi Kwarteng back in October, November last year. But
that feels like a long time ago. We did
I know
that
that
one.
feels like a long time ago, doesn't it? But it really is.
Yeah.
But we saw a lender last week pull all of their products from the market because swap rates were too high. They'd reached the peak of their hedge and they were like, right, okay, we can go no further. And I think that was Thursday last week. They pulled every single product and all of their pricing. They came back into the market on Monday with exactly the same pricing. I mean, if that doesn't scream a lack of confidence in the wider market, then nothing does. So I think probably what a lot of us are striving for is looking for calmer waters that enable you to make long-term decisions. And I think that's something that customers are struggling with, investors are struggling with, lenders are struggling with, because we haven't got that same long-term view that we've enjoyed previously.
Rhys, very polite of you to put your hand up. Normally you just stand
I was just saying, maybe we should open it up to the audience in terms of where they see base rate. I'm not sure if we can do a Q&A either at the end, but it's always me and Stu and Kerry who get you put us on the spot. It'd be good to record this and then maybe look at it on the next one to see exactly who is correct. I know.
Yeah, my feeling is that we'll get to 5.5. I don't think it will go any further than that. I think that's where we'll peak before it starts to come down.
I think we'll surpass 6 by the end of the year. But
yeah. We'll see. We'll see. There you go. Hold us against it. We'll put a tenner on it, Rhys, and but just interested to move on slightly. How are you guys having to modify your approach, or are you modifying your approach? So for you, Rhys, we've just come out of a world very quickly. It doesn't seem like very long ago that businesses were able to access a bounce back loan at 2.5% with no personal guarantee. Now suddenly, if that was their first foray into debt, their expectations are going to be pretty wild. So we can't just spit out an offer now for 15% and expect them to take it. For you, Stu, you've obviously got the increase in base rates affecting the offers that are available. Valuations are coming down. Quite timescales are lengthening. Quite often we seem to be the bearer of bad news a lot of the time, or coming across that we are. And then Kerry, you probably are saying no more than you are yes to lots of businesses. And there might be a bit of a waiting game whilst we wait for things to stable out. But obviously you want to keep those relationships close. So how are you all of you guys are changing your approach when it comes to working with accountants or working with the client directly?
I can go first, Sam. It's more setting the expectation from the outset. Many of the advisors and clients that we work with, that the clients may be in the bounce back times where they do think that lending is as cheap as 2.5%. Those days are gone, unfortunately. Those were, you look like they're the glory days for any business owner, not in the sense of the economic conditions, but in terms of lending. Where we're at now in terms of setting expectations is usually where I feel the team are good in terms of, okay, this is where the rates is roughly going to be based on your circumstances. And then it's then working with the advisor and our internal checks as well as, can the business afford it? A sense check, are they making the wrong decision? And 2, prepping any business owner and advisor for, these are the rough monthly rates, terms, monthly repayments and loan amounts. And that would be before engaging with any lenders that we work with. There's 2 reasons why we do that. And the first is making sure there's no credit checks done on any clients that are unneeded if they're miles away in terms of expectations. And 2 is lenders remember clients coming back. They have logs because they've spent time underwriting these deals. We spend time speaking with clients, and we're happy to do so, to educate clients. But as soon as it's in with a lender, lenders remember clients, and they will remember if they haven't taken previous facilities with them, and then they have to reapply, etc. What we see is sometimes the rates do increase, whether that's to do with base rate, or if that is, you know, another contributing factor. Where we're kind of seeing the difference between the last, let's say, 3 to 4 years is the average loan that we're seeing is a lot lower. And that's mainly due down to government backing of the CBILS and RLS facilities that many accountants may have taken, advisors, businesses may have taken. And where they're looking at now is those levels aren't pretty similar to Stu with evaluations. They're not there unless there is more affordability, because lenders don't have the backing of the government to cover 80% of a loss if that was the scenario for any client defaulting. So just to answer your question, Sam, it's more prepping from the outset with both advisors and clients to make sure that the reality of what Swoop provide is, one, the most appropriate facility in the market, but two, they know from the outset before they potentially engage in further conversations with contractors, with marketing, with anything that is going to effectively use the loan for. On the asset side, where we're seeing we're seeing a more increase in assets being used than unsecured. So the market, if I go back to kind of government funding times, is a lot of the debt wasn't done through commercial mortgages, asset finance, invoice finance. It was predominantly done through the facilities on a loan, because one, they were pretty easy to get from the high street bank through alternative funders, because they had the government funding. Where we're seeing now is the FLA, which is the Finance Leasing Association, have put out a report, and there's been a 27% increase from the previous financial year in terms of leasing and asset HP, so hire purchase. So where we're seeing the market go is because they are registered against assets, they are a cheaper facility for a business owner to utilise, purchasing machinery, soft assets, that could be software, refurbishment, equipment, etc. So there's been a bit of a shift in the market.
Cool. We're going to dig a bit deeper into asset finance, the opportunities that are there a little later on. Rhys, we've had a comment from Darren Connolly. Thanks, Darren, for your comment. And he's talking about one of the biggest challenges that he's got at the moment is convincing clients that the age of single-digit rates are rare unless you're with the high street. So if you want speed and quick decisions, you're in the double-digit market. Is that where we're at? Is that part of the challenge?
That is where we're at. We do see single digits often, but more than less, they are double digits, low double digits, or to medium double digits. The reason for that is, as we discussed earlier, is the base rate. It's the risk that they're taking as a lender, whether that is the high street or a second tier funder. The way that we discuss this with advisors and clients is, what's the opportunity of taking this money? Is there anything else that we can help support your business with? If it is energy, FX, moving bank accounts where you're not paying £20 on a chaps fee, all these little things take that when you're a business owner you don't really think of, because you're not aware of them. So it is then mitigating the costs elsewhere to effectively put this facility in place. But from our side it's okay, if it's going to cost a low double digits, what can this money bring to your business? Can you double your revenue from purchasing an asset, or can you double your revenue from increasing in marketing spend, hiring people, increasing your software? And it's actually sitting down with the client to say, we know that this is the current market. If you don't take this money, what happens? The also flip side is, within the unsecured market, a lot of the facilities are fixed. So if we do see an increase in base rates up to whatever, it could be double digits, who knows, in the next few years, that for the next period of 2, 3, 4, 5, 6, 7 years, that loan repayment is fixed. Yeah. And then it's also, Sam, in terms of looking at the early repayment option. Is there an early repayment option if base rate does decrease over the next 2 or 3, which I think it will do? And then it's looking at, okay, well, if I've got this for 2 years, but it drops in 2025 to 2 or 3%, will I be able to refinance it?
Yeah.
If base rate drops, more likely it's going to be more cheaper money.
Yeah, for me, this is all a big opportunity actually for the accountant themselves, and this is where they can really show the value of their own advisory services in-house. So it finally, if you're ever struggling to sell the value of cash flow forecasting, detailed management information, you know, in this type of environment, if you're trying to model out whether something's affordable for a business, you know, there's so much value in that cash flow forecasting service. And I know, Stu, you, with a lot of some of your favorite accountants, that's really where they nail the specialism, isn't it, on the value of that cash flow forecasting.
Yeah, and it brings us full circle to that education piece around pricing, because, you know, we come across some customers that think, well, I deserve 2 over base. Well, you don't. That's the reality of it. But I think Rhys has nailed it there, is that you've got to look at the opportunity cost versus the interest rate. And that's where forecasting something out like that will really, really benefit, because you strip away all of the focus on a percentage and an interest rate. So you actually look at the financial impact that this will have on the business. And it should, as long as the numbers stack up and it's the right decision, that should make it abundantly clear, but you use that as the tool to educate your customer. That's what we find ourselves doing more often than not nowadays. I think just to loop back round to your original question as well, Sam, as to are we changing anything about how we're working with customers? I'll be honest, no, we're not. And the reason that we don't is because we've always worked off when we have an initial conversation with the customer, and I implore accountants to have this at the forefront of their mind when they're talking about commercial mortgages and property-backed finance, is there's 3 key areas that we've got to get lenders comfortable with. The first one is always experience. Do they have experience in the field that they're looking to work in, or whether it's investment property, whatever it may well be? Do they have experience or transferable skills that they can bring to the table? The second one is security or skin in the game. You know, are they after a reasonable request? Nobody's ever going to lend 100% loan to value on a property. They will do if you've got additional skin in the game to put in, i.e. additional security, but nobody's going to give you 100%. So it's making sure that that balance between the lender risk and the borrower risk is at a satisfactory level. And then the third point is, does it service? Can it afford to repay it? And I would probably say now more than ever, that is the primary concern. You know, stress it, you know, put a 10% pay rate on it. Does it pay? Does it service over 20 years at a 10% interest rate? And have you got circa 150% repayment cover from your last year's accounts? If you can answer yes to that question, there's probably a deal in there. If you can't, then the reality is you're going to be pushing water uphill, because you cannot demonstrate that business can afford to repay that debt that it's looking to take on. So I think those 3 principles have always been the focus of our team, and they always will be. The other bit that we've always done very well, and this is, I always find this a really tough conversation because it's not necessarily something that you can sell. And when you look at the protracted deal times that we go through as a team and the amount of stakeholders that we have involved in a deal, you need somebody to manage that. And that's where we drive our value. So whether that's chatting with the accountants, both buyer side and seller side, whether that's talking to the client's lawyer, the lender's lawyer, or even the vendor, or even the client's lawyer, the vendor's lawyer, or even the lender's lawyer. So there could be 3 sets of lawyers involved in a deal. The valuer, there's that many stakeholders that we need to bring together, and we're the conduit that sits in the middle, and that's where we drive our value. So our position with that has never changed. It's got harder because everyone wants their I's dotted and their T's crossed in a little bit more detail now. But we are still that driving force behind the deal, trying to move it forward as quickly as possible, but without sacrificing quality. So we've not changed, but it has got more difficult, is the reality.
What about you?
Yeah,
what about you? Has the approach changed from Swoop's equity team?
Yeah, I was going to say, I'm getting unlucky going third in all these.
I know. I won't.
First in the next one, because
yes.
I mean, it's a similar story on the equity side. I think while the overall conversation is pretty much the same, my job is essentially to help people find investment. It's also a case of managing expectations and really looking at valuations. So in 2021, you saw like hugely bullish valuations, businesses getting ridiculous ridiculously generous valuations that might have even been pre-revenue. So now it's kind of a case of, you know, investors are sort of being a lot tighter again, doing more due diligence, pushing on bringing that valuation down. So I think founders need to firstly consider how much equity are they actually willing to give away. Do they maybe need to reduce the sum that they were initially raising? How long can they extend that runway? Sorry, a lot of jargon, runway in terms of extending how long that money will last them. We're working with so many pre-revenue businesses as well. So kind of looking at how much could they potentially drag out their raise? How far could they go without raising investment? How could they get to revenue stage without investment if it's possible? So kind of, yeah, I think particularly even from a Swoop perspective, like we're raising at the moment, and I know Andrea and Kieran have kind of said that they've had to go, okay, do we really want to raise that much, or will we raise a little bit less, drag it out a bit longer, go again? So that's kind of something that I suppose has changed in terms of our conversations. Again, similar to the guys in terms of just being quite frugal, looking at all the other areas where you can kind of improve your own financial position. Like investors aren't really going to be looking at your credit rating, particularly for a pre-revenue business, but you know, have you been doing your R&D tax credit claims? Have you been looking at grant funding? Have you taken on some form of debt if you can, if you're in that position? And you know, I just spoke to a business the other day who had just received equity investment on the basis that they had secured a loan and they'd been repaying it like very, very easily, and the investors were quite impressed that, you know, they didn't do that through equity. So it's kind of depending on the sector, that can also be a good route. Rhys, I don't know if you just put up your hand or if that's from a while ago.
No, it was on something completely different. Carry on.
Okay.
In terms of processes, is what we're showing is more the tax deductible side of the interest rates on certain equipment to show, okay, the interest rates are higher, but you're also saving elsewhere. So it was just to kind of go back to on Darren's question as well, on that side.
Yeah. But I actually meant to say also, when you guys were talking all around like the loan side of things and looking at your other options, it's been quite interesting from an equity perspective in that we've had, so typically we're going out to investors, sending them deal flow, saying, what do you think? Would you invest in this? But we're starting to see a lot coming the other direction from investors saying, can you have a look at this portfolio company of mine? Like, are we definitely exhausting all options? Can we review their loan? You know, could they be applying for some form of grant, or do you have any other investors that might be interested? So it's really a reflection of the market that investors are coming to us with that kind of request. I mean, it's great for Swoop, but it's also quite telling in that even investors are kind of looking at how tight they can be with their existing investments. But then I think also, just to be a bit more positive, because we've been very negative up to now, one thing to note, and I mentioned this on the last market update, is that a lot of these venture capital funds that invest on behalf of individuals are set up with mandates to invest a certain amount of new investments every year. So there is capital to be deployed there. But it's something to really, really keep in mind when you're going out looking for investors, whether you're helping a client to do that or you're doing it through Swoop, is looking at whether or not they're actually deploying their cash. So a lot of funds will have a new fund out specifically for new investments, while others might have a lot of dry powder, as they call it, but they might actually just be reinvesting that in their own portfolio company. So the advantage of Swoop there is that because we have those relationships with the investors, we know when they're actively investing, even though it might say on Bohurst or Crunchbase, oh yeah, these guys have a new fund, maybe half of that's going into existing investments. So utilizing your time, because fundraising is extremely time consuming. And back to, I think it was Rhys saying about kind of the opportunity costs there, and making sure that you're actually doing all of that outreach at the right time and for the right reasons. And then also at the right valuation. So that can be a tricky conversation, particularly for pre-revenue businesses. But yeah, it kind of can link into grants as well separately, but I feel like you're going to ask me about that in a few minutes. So
yeah, just continuing our move onto the sunnier side of this half of the webinar. So Kerry, we're definitely not seeing a slowdown, are we, in the number of startups that seem to be appearing? There's still plenty of appetite for people going it alone and building their businesses. What options are there out there? I mean, a startup loan is the best loan on the market now, isn't it? In terms of the that's possible. It's not moved. But what other options are there?
Sorry.
You lost your headphone.
Sorry, I'm here. These bloody AirPods are too modern for me. Yeah, so I think I actually read something really interesting the other day about kind of the UK's ranking in terms of the G7, and our entrepreneurship levels are so high, and it was all really kind of down to startup loans, is what they were saying anyway. Like the UK startup loans are brilliant. But also I think the grants landscape in the UK is really underrated. And I'm from Ireland, and I remember when I first joined Swoop and kind of got into the research of the UK grants landscape, I was so impressed by it. So there's like a record level of funding in innovation grants at the moment. So any businesses that are doing something really game changing should definitely be looking at that and making sure that, you know, you're keeping that top of mind. It kind of links into the equity side of things quite nicely, in that like there's 4 areas that Innovate UK are focusing on at the moment. And that's actually where we're seeing quite a lot of trends in equity, positive trends in equity. So that the 4 areas are, I mean, we could probably do a little poll of guesses here, but the first one is obviously AI and data. So there's a lot of funding there from Innovate UK. You know, there was a recent grant for AI feasibility studies, which was nice because that was quite early stage businesses that might have only had an idea. And obviously the Smart Grant is ongoing all the time. But then other areas that we're seeing things are like aging society, so kind of med tech, I suppose, all that kind of area. Sustainability, carbon reduction has been a really hot topic at the moment. And then things around future of mobility, which kind of links into the carbon reduction as well. So I saw some grant that was launched yesterday around carbon reduction within the train infrastructure. So quite niche things, but also just shows kind of that the government is trying to fund these businesses that wouldn't get traditional debt or might also struggle to get equity. And I know you're probably going to ask me around a case study in a while, but we had quite an interesting one, which kind of links into your last question, where a business came to us looking for equity. They were in that kind of med tech aging society space. No investor interest, real struggle, have to be the bearer of bad news. But then we actually introduced them to a grant writer. They just won quite a large grant, kind of in the 500,000 sort of figure. And as a result, we've got a lot of investor interest, and they just got a term sheet today. So it's kind of, I suppose, when you say there's loads of businesses popping up, it's because there are those funding opportunities. So if that business had never got an investor, it could have been goodbye, but then because they got the grant, the investors were very impressed by that, and we're like, okay, you're obviously doing something pretty impressive. And I think Innovate UK providing a business with a grant is almost half the due diligence done in a sense. So
okay.
Yeah, I think.
Can you just quickly give Darren a flavour of the grants and schemes that are available for SMEs in Ireland?
In Ireland, yeah. Okay, so I should be the expert on this, and I am doing a lot of research on this at the moment because I kind of overlap on the 2 markets. But I mean, obviously you've got Enterprise Ireland. So for all the UK advisors on this call, Enterprise Ireland is essentially a government funding body in the UK, in Ireland, but they essentially act as a venture capital firm at this stage. They provide a lot of funding to Irish startups. So we're seeing like a lot of a focus on kind of agriculture, which is great because obviously the Irish scene is pretty good on the agriculture side of things. But also there's going to be a big focus on European innovation grants. So I think a lot of those should be on the Swoop grant finder tool, and you should be able to see those. But like more than happy to kind of do a bit more research on that as well. But yeah, it's kind of similar themes to the UK in terms of sustainability being a big focus, and then agriculture is another area where we're seeing more and more. But Enterprise Ireland is probably the main provider of those grants, and then there are a number of others as well, but they'd be kind of more regionally focused, so it would depend on the business and where they're based. But yeah, we can definitely look into that for you guys if there's specific clients.
Well, Darren, we'll link you in with Kerry after this if you've not met before, and she can give you a bit of a deep dive into the Irish market, if that's right, Kerry.
Yeah.
Cool. Right, moving forward, there's a few different things I can't believe how quickly this is going. So let's get back to the sunny side again. Rhys, Stu, and Kerry, can put you third this time again. Any highlights, case studies, things you'd like to share from the last quarter about, which gives a flavour of what there is to look forward to, or just to give us a bit more optimism in the current market? Go Stu. We'll go Stu first.
Yeah, fine. I was going to jump in. Appetite genuinely remains strong from lenders, but the just to bring us back to those challenges, the big challenge that a lot of businesses face at the moment is proving serviceability and that they can afford to repay the level of debt that they're seeking. And a lot of the lenders in our space look at historic accounts. So whilst current performance might be very, very strong, they're always looking backwards to confirm serviceability, never really looking forwards. If you want lenders that are going to look forwards, there are lenders in that space. But again, there's a point that was raised earlier, you're going to be looking at double-digit interest rates, even on the secured side. So the huge positive is that, yeah, lenders are still very much in the market. They need to lend money to make money. The appetite remains strong. And we're actually seeing this as a little bit of the comeback of the high street. I think some of the high street banks and the tier one banks have realised that their market share has dipped significantly, particularly when it comes to new business. And the increase in interest rates has enabled them to become more competitive. So to use a case study, we're working, and to raise a point and support a point that I said earlier, some customers think they deserve 2 above base. Well, sometimes they don't, but sometimes they deserve better than that. And we're working with a customer at the moment where we've got them just shy of 3 million quid to acquire the site next door so they can grow their business. Long established business, been going for 30 years, no debt in the business at the moment, absolutely flying, both in terms of historic financials and where they're looking to go in the future. And we've secured them a rate of 1.37 above base with a high street bank. So where there is genuine appetite and there's good businesses to be supported, then the high street really will push how far they can go in terms of pricing.
And that's just on high streets quickly. There might be an assumption that a business like ours just favour the alternative lenders and the ones that some of our accounts, etc., might not have relationships with. We're very much there with the high street banks as well, aren't we? And there's still a huge amount of power in a business like ours to work with those high street banks. We always start with the high street banks because that's where we'll get the cheapest money for our customers and for advisors for their clients. That is where we will get the cheapest interest rates. That hasn't changed. That's still the same. But if you want it to work for the high street, it does have to fit in their pretty little box. If it doesn't, that's when you start working your way through the tiers and we look to get the most competitive terms that we can. But yeah, the high street is coming back. They're more aggressive on pricing than they've ever been. There's certain sectors that are really, really hot at the moment. Professional practices, so accountants are one where we funded a few over the last 12 months. Appetite remains very strong for those, both from a property perspective and an unsecured perspective, which I'm sure Rhys will cover off in shortly. Medical sector, anything white coat, appetite remains huge for those. So pharmacy, dental, GPs, those sectors are still very, very much looking to be supported by the high street. Education and childcare is still a massive one. So whilst children's day nurseries have come under a lot of pressure recently, both in terms of costs that they've had to absorb as businesses and they haven't been able to move fees forward, it's still a really well supported sector in terms of how lenders perceive it. And I think the primary reason for that is that if you compare it to something like end-of-life care, like elderly care, I think your traditional banks have had their fingers burnt a lot in that elderly care sector, whereas in childcare, they've never really had any legacy issues, so they're a lot more confident with it. But I think where there is, this may sound obvious, and it often is, but where there's a long-established business with a good management team, you can tick those 3 boxes in terms of experience, skin in the game, and serviceability. There's still very, very much a deal to be done. And there's still some cracking deals to be done. A huge positive as well is that we've seen
the tier 2 market and the pricing differential between the high street and tier 2, that gap narrow. So, you know, our role is to work with customers and understand what's important to them. If it's somebody that needs cash tomorrow, then you're not going to get your 1.37 above base, because there's lots of hurdles to jump over with a high street bank. So the first question that we often ask a client when we talk to them is, what is your key driver, speed or price? Because the reality is you can't have both. There may be a trade-off somewhere in the middle, and we'll help you find that. But dependent on how urgent this is, will dictate where it needs to go. If somebody wants both, then we might have to do something quick and short term, which is going to be more expensive, but you've just got to acknowledge you absorb that as part of the deal cost. And then you refinance it out for your finer rates, finer margins and rates at a later date. But the positive is that there's still very much appetite from the lending space in the property-backed lending space to support it. Investment has come under pressure because low yields with high interest rates, the numbers just don't work. So the focus is very much on owner-occupied, which is where we tend to excel. I think 80% of our business is in that owner-occupied space. So anything that involves a trading business, the appetite remains very strong for that. And the primary reason for that is that you have visibility on its performance. Whereas with an investment property, you're relying on a tenant to service the rent, and you don't have visibility on their financial performance. Whereas with an owner-occupied commercial mortgage, you get the accounts, you get the MI, you get your quarterly update if you need it, if it's a condition of the advance. You've got full visibility, so there's a degree of control. In addition to that is that there's levers that you can pull with the trading business. Unlike an investment property, the rent is a rent for a fixed period of time. If you've signed a 10-year lease with a tenant, that rent will be that rent for 10 years. You might have the odd rent review or whatever. But with a trading business, there's levers that you can pull. When you do have these inflationary pressures, good business owners are increasing their prices. They've got to. Or if there's an opportunity to restructure and reduce cost, you can do that. But there are levers that you can pull to manipulate financial performance and demonstrate serviceability. So and lenders are very much buying into that space and understanding, yes, they're asking more questions than ever to properly get under the bonnet and understand the business a bit more, but it's well intentioned because the appetite is still there to support it. And I think that's probably where we come in with our sort of experienced heads. You know, the team, the vast majority have done circa 20 years in financial services. We help navigate and answer those questions before it lands on a lender's desk. So when it does land on their desk, it gives us the best probability of getting it sanctioned first time around at the cheapest rates possible.
Yeah, I think it's a great reminder as well that we're not just a fintech platform, and actually there's a ton of experience behind the scenes which really comes into client experience. Rhys, have you got a couple of examples from the last quarter where, whatever you want to share, but hopefully something where we've gone above and beyond from a customer experience point of view would be quite
conscious of time because I could go on all day, Sam. So Tell me if you need me to stop. But one of the, I guess, you're kind of proud of people you work with, and when you're proud of people you work with within the team is helping business owners out of sticky situations. And there was one which has been a clear factor for this last quarter, which was a machinery business dealing with a blue chip client, precision engineering. And what they'd essentially done is they were on a 90-day term with the blue chip, never experienced invoice finance before, never experienced a delay in being paid, relatively new start business, taking on a load of contractors. The blue chip stops paying them because they can, because that's what they do. All of a sudden, they've spent money on machinery, they've spent money on hotels, costs, and they're literally about to go under. We took on this, the client, one of the funding managers within the team, understood the need for the client and the urgency, and they needed cash in there to effectively save the business. So how we deconstructed the client was actually looking at what they've spent money on the last 6 to 12 months. They bought a machine, didn't use asset finance. We said, right, let's use that asset, let's refinance that over a 5-year period. That extracted £70,000. It then gave them headway to then chase up the invoice with the blue chip supplier. They've now got an invoice finance line in place, etc., and the business is back up and running. So for me, that was kind of a proud moment. For one, we've kept the business afloat, we've kept jobs intact, but also how quickly that was turned around for the business to stay within the industry and kind of keep going was essential. The last one.
You've also genuinely come into that with fresh eyes as well, haven't you? So the business might have dropped onto the platform or been introduced thinking it needs something, and actually you've come up with a different solution.
Well, they come on needing a term loan, a short-term loan, because they knew that the supplier was effectively going to pay them within 120 days, but that period of not being paid would, put a lot of it would have put the business under. So being reactive and understanding the business needs and actually extracting what's happened over the last couple of quarters to see, right, well, where has this money been spent? Okay, what assets are in there? Understanding the balance sheet, because not everything is about profit. A lot of people in the industry will think profit is the be all and end all. If you're not making a profit, you can't borrow. That's not true. If there's assets in there, there are lenders out there which we can utilize assets against to leverage some of the balance sheets out into cash. So that was a kind of a tap on the back moment for one of the funding managers in the team to say, you've really helped the business there, kind of save the day. I've got a couple of other examples. What's the time?
If I can, Rhys, I'm going to force your hand on another case study, and given our audience, if you could just, if you know enough about it, just talk about some of the acquisition funding we've done for accounting firms, because we're seeing more inquiries at the moment to support accountants with their own cash flow, but also on a more positive note, we're seeing more and more inquiries about acquisitions in the market, and we're definitely seeing some consolidation out there. So would you mind just running through a quick example of the Brown & Co?
Yeah, for sure. So in terms of the accountancy acquisition, the trading business that's been trading a number of years came into Swoop wanting to acquire a competitor or another accountancy practice. We provided the funding at 100% loan to value, basically based on the existing the existing practice running itself, but by a purchase of shares. What that meant was within a space of 2 to 3 months, once they've done their due diligence, there was a facility provided that would mean that the accountancy practice could purchase the competitor further down the line. What that means is then they can start working together to consolidate costs, looking at moving the book into the existing practice, bringing on people and then hiring. How Swoop looked at that, and it was Mark who would deal with that exact transaction. We've done many across the team, but in terms of that, is again, it's understanding the needs of the business which is purchasing the vendor. And to do that, we deconstruct everything. We look at property. We look at any assets that are existing in the background. We look at what the lenders are needing within the market. What is the existing performance of the current business? Can it afford to service additional debt without the new business? Do we need to do a consolidated cash flow forecast of once both are consolidated with the reducing costs? Is there a deferred payment? And this is where we've got expertise, which is coming away a little bit from the fintech, which actually takes a more solid look at everything that is involved within the process, to then go to the banks, lenders, and say, you cannot sign this deal off and you cannot approve this because we've mitigated every risk. Yeah. So I can share the case study. Sam can share the case study on that exact transaction. We've done some more which we can share as well. But again, if there's a massive market in there, like Stu's commented on, for acquisition funding or refinance.
Yeah, if anyone's got any questions about cash flow for their own accounting firms, or they're looking to make any acquisitions, please do reach out, because we're doing this stuff all day long at the moment. So it's still a great time for professional services in particular to be looking to acquire or looking to lend. So just conscious of time, Kerry, do you want to share a case study or some happy news in both the grants and the equity world? And then I want to finish with everyone focusing on some key takeaways for our attendees.
Yeah, Rhys, you reminded me of that picture you sent into the Slack channel about how ChatGPT can't replace human skills. So I think that's quite a positive actually from all of this, is kind of where Swoop, the human element is really, really powerful. And I think that case study is a prime example of, if that business would come to me, I wouldn't necessarily know what to do, but we have the specialists in each area that we can rope in. So kind of, I suppose my favorite case study is that one that I already just mentioned, that business that came to us, needing an investor. They weren't aware of the particular grant that was almost written for them. They secured that grant and they probably would have been fine without investment. But now, as a result, they've got the top-up investment as well. So they're really nicely set up, and it's just kind of a nice case study of where Swoop can help on that full circle. But I suppose also, like, less of a case study, but more of a positive note is that this whole kind of market reset, in a sense, is making, I think, investors a bit more educated in terms of how businesses should be, really trying to extend their runway. Keep talking about the runway, sorry, the lingo. But yeah, how they should be kind of a bit more frugal. And I think as a result, investors are being more picky, but we're also then seeing more specific trends in specific sectors. So things like, hate to say it, if there's anyone with clients looking for funding in the drink space, for example, it's just really, really hard for us at the moment. And we can kind of make decisions a bit quicker on that basis, because we know that investors are looking at specific trends such as AI and data. And you might have seen the Mosaic ML transaction this morning. So they were sold for 1.3 billion, a 2-year-old business. So the cost of the sale was like, I think 21 million per employee or something. So it's just kind of good to know that if anything comes up in that space, we firstly need to kind of screen it and make sure that they're not just throwing AI into the pitch everywhere they can, but also that if it's something that is actually genuinely leveraging AI or doing something genuinely innovative, there's a bit more of an investor appetite there. And we kind of know that, the figures that you need to be looking at for more B2C businesses and things like that. I think also, while trying to make it a negative into a positive, while due diligence is taking a lot longer, and similar to Stu, and that transactions are taking a lot longer, I think hopefully it's a better long-term investment. The investors are making the investment for the right reason. They're kind of not just throwing cash at businesses for the sake of it. So hopefully the businesses coming out of it will come out a lot stronger. And I think, it's good for the overall landscape. And then lastly, I think it also is really kind of following on that point, the businesses with the really, really strong teams are the ones that are getting funded, particularly in the pre-revenue space. So there's much more of a focus on the quality of the team. And while the product is obviously extremely important, I think it's just good to see. I helped a pre-revenue founder there get investment, and it was purely based on what she had done to date, bootstrapping it herself. But also she kind of overlapped in the AI space and sustainability space. So two themes that we're seeing a lot of. So I suppose from my perspective, I think it's a little bit clearer actually, in a sense, as to who's getting investment and who's not, because there's less money being thrown around.
Yeah, brilliant.
And then also grants, as we mentioned, are a great form of funding as well. So just kind of keep looking at that.
Yeah. Thank you guys for turning doom and gloom into the sunlight again. If we can just have 1 minute each and just give a couple of key takeaways. Kerry, by all means, do grants and equity. You can have 2 minutes if you like. But yeah, just some key takeaways that they can, our advisors can go back to their client base and spot opportunities, or just with a little bit of education that they can pass on. If we can go around just a minute each and a few takeaways for people to go away with.
Mm-hmm. Yeah, I think I kind of, to summarize everything I was saying across the hour, I think on the equity and grant side of things, the reason that we pair those two teams as one in Swoop is because there is quite a bit of overlap. So businesses that are looking to raise investment often are doing something very innovative and should be looking at grants. So really just keep that in mind. If a client is saying, oh, I want to get investment, just make sure that you're covering all your bases on the grant side of things. And things to be looking at is kind of we hear game changing being said all the time. Like, are they actually transforming something, or are they using something that already exists in a new way that hasn't been done before? So the kind of key point is hasn't been done before. And you'll hear a lot of clients saying they've no competitors, but that competitor analysis is particularly important on both the equity and grant side of things. But yeah, I think kind of thinking of equity and grants kind of together would be my kind of key recommendation from this overall webinar. And then that also circles in with the guys in terms of just looking at the overall funding landscape and making sure that you're exhausting all options and not just, you know, focusing on one particular niche. Brilliant.
Thank you, Rhys.
Yeah, sure. I think the key takeaway, I don't think it's been a whirlwind. I think for me is where the market isn't necessarily aimed at loans anymore. It's looking at the balance sheet and what cash can be extracted, if there is any, but there's also some unique facilities, VAT funding, advances on other VAT, corporation tax for individuals, for businesses, it's anything that effectively is a big cost. There's more than likely a product that we can provide which will assist in spreading the cost over a period of time. It's looking at the tax breaks as well, the tax advantages of leasing, taking on smaller loans potentially. It's basically looking at everything that a client needs rather than, as was mentioned previously, the interest rates. And it's looking at everything in a circle, and we can help on that side to say, actually, it's worth actually looking at taking more out of your commercial mortgages, or looking at your invoice finance facility, because we actually think we can reduce that cost rather than a new facility that is away from an existing facility that they have, such as invoice finance. So what I would say is if there are not clients just needing urgent cash, because that's not the case at all, it's being on the forefront of your clients to making sure that they've got the best possible facilities in the market.
Brilliant, thank you. And Stu, do you want to finish up?
Yeah, Rhys, it's lovely that we're on the same page, but it's equally frustrating that you've stolen my thought for. But yeah, so there's sort of two key takeaways for me. The first one is it still revolves around people. Who are they? What have they got? What skin have they got on their back? You know, how good are they at what they do? That will, for me, that's a principle that will never change. It's certainly in the debt markets. People want to lend to experienced people that have a proven track record. So if you haven't got that, find a way to get it is one of the key takeaways for me. And the other point, which Rhys mentioned, is that the market evolves. There's never been so many products available from a debt financing perspective. So this doesn't just correlate to property-backed finance. This is looking at the whole commercial finance arena. There's never been so many products available to SMEs, which is great. That's fantastic for SMEs, but it does also present a challenge in navigating that market. So my key takeaway for advisors that are on this call would be, use us. We're here to help you and help your clients. If there's a requirement there, you know, there may well be a primary objective that they wish to achieve. Well, actually, there might be multiple ways in which we can help them achieve that. It's not just assuming that one product or one size will work for them. So use the knowledge and experience. Both, you know, all of the teams across Swoop have got a wealth of experience in all of their markets. We'll work collaboratively to get the best outcome for you and your client. And I think that's the most important thing to take away.
Just to add to that, Stu, Sam, before you wrap up, if your clients have existing offers on the table or are speaking with brokers in the industry, banks directly, we're always happy to pick up and sense check, give it the rubber stamp, say that is a great deal, or actually we think that we can better this, but it's going to take 2 weeks, a week, etc. That sense check is what we're here for, is to support yourselves and businesses globally to make sure they're accessing the right products available.
Yeah, I couldn't agree more. One thing I always get asked is what makes our most successful partnerships, and I always say it's with those that are most needy and most demanding. So I always give people the green light to be needy and demanding. The more questions you have, the more you get us involved with your clients, etc. It's win-win for everyone. So please don't be a stranger. Do reach out and use us, because we're here to support you. Just conscious of time, sorry that we went over a couple of minutes. These guys have a lot of value and experience to give, and they're very passionate about what they're doing. So trying to get 3 different heads of in three very different areas to squeezed into one webinar is always quite a challenge. But hopefully everyone got something out today, and we'll follow up anyway with some of the key areas that were discussed. So, and if you've got any questions, please do reach out. Thanks everyone for joining.
Thanks everyone. Thanks, Sam.
Thank you.
Cheers all.
Cheers.